Rob. How are you doing?
Hi, Chris. Thanks for having me. I'm doing great. How are you?
Yeah, very good, thank you. Yeah, it's been a long time coming that we get you on this webinar, and you're going to basically share your experience and some of the below market value deals that you see come across your desk. But before we get into that, what I like to do with these sessions is talk a little bit about your experience, how you got into property in the first place, and maybe just give us a little bit of a journey through your career.
Yeah, thank you very much. I've been in financial services for about 25 years now. Um, so how I got into property, well, it's kind of combined with how I got into financial services. So I started out as training as a financial advisor. That's what it was, pre-credit crunch, so before 2007. Um, and what I was doing is I was advising clients on holistic financial planning, not specifically property, but everything else kind of in between, from inheritance tax, pensions, investments, cash strategy, retirement planning, business tax, all sorts of different things, really. And a little bit of property in there, a little bit of mortgages and insurance as well. And then, really, what it was is 2007 came. We obviously had that massive financial issue. And when you see the graph of, how property was kind of growing, it was year on year, it was really stacking up. And it got right to the top of that graph. And then you see the sharp fall, don't you? Well, right at the top of there is where I bought my first property. So that's where I bought my first one. You can see there's a little flag on there with my name on it. And then when I came to try and sell it a couple of years later, it was obviously in negative equity because I bought it at the top of the market, and I didn't really know what to do with it. I was financially trained, but I wasn't a property investor. Understand assets and asset classes and diversification, how to build wealth and goals and all that stuff, but not really property strategies at 2007. But by luck rather than skill, it turned out that it was in a decent area where I could rent it out. So rather than sell and make a loss, I did a refurb and I rented it out, became an accidental landlord, and that kind of opened my eyes to, I can make a return on this. And so from there on, I kind of started to buy a few properties here and there until I really started to focus a bit more in the last 2 or 3 years, really, when when we set up this business, Simple Fast Mortgage, and we support investors and developers. So constantly around that circle, has focused that strategy, the property strategies a lot more.
Great. And where did you buy your first property?
Yorkshire. So I'm a Yorkshire boy. I'm from the north of the country. I run my business out of Manchester now, and we have a registered office in Holborn and London as well. And although we operate nationally, I'm actually based out of Yorkshire. But one of the key things that I wanted to put in place when I created my business, Simple Fast Mortgage, was I was sat on a terrace in Cyprus, and the sun was going down, and I was having a nice cold drink, and I was talking to the person I was with at the time and saying, wouldn't it be good if we could just have the freedom to kind of do this whenever and work from wherever, and not be limited by location, have location freedom. And at that time I was a consultant contractor, so I worked in different companies all around the country in their offices, and I was really tied to their offices quite a lot. And I spent most of my life in a hotel, to be honest, away from home, so which was quite the opposite. So it was at that point that I decided that I wanted to do that. So all my team are remote now, so we all work from home. We're not really governed by location. Our clients are national and international, many countries around the world as well. And it doesn't really matter where we are. So that was the kind of vision that created that.
Amazing. And I imagine, obviously, with your office in London and office in Manchester, you're seeing quite a wide range of properties, quite a wide range of cases hitting your desk from all over the country. Are you seeing sort of any trends at the minute that are sort of consistent, or is it quite regional based?
Yeah, so we see quite a lot of most things. to be honest. We've got clients who operate in pretty much all sectors of the property market, from commercial deals, looking for, commercial assets, which kind of sit further up the hierarchy of asset acquisition. So you're usually looking at your, high cash flowing assets, which are usually a bit more noisy, HMOs and serviced accommodation, and then kind of moving through that hierarchy to then better quality, lower yield, higher capital growth, kind of self-managed properties to some degree, which, are long-term holds for generational wealth.
Mm,
And we've got clients who are in all stages of that journey, really. So we do a heck of a lot of HMO business that tends to be focused around the north of England, just because property prices are lower and the access point is easier. There are people who do it in some spots in the south as well, particularly down around Nottingham and places like that, Kettering. But mainly, I would say Manchester historically, although a lot of it has gone to Article 4 or is going to Article 4 within the next 12 months. And then we're seeing an increase in market even further up north, in the northeast, particularly around those areas as well for HMOs. Buy to lets, they never really die. They quieten down, but for good buy to let investors, there's always properties that can be picked up and value can be added. That's pretty much universal around the country. So yeah, a good mixture of stuff. We're probably a little bit more heavily based in the north because of the access points for people to acquire property. It's cheaper, right? It's cheaper than the south. But other than that, no strong trends that are coming out. Seeing a lot of people who are more interested in the kind of long lease model. We do see a lot more of that than we have done in previous years. So, leasing to 5 years to a charity or a social care or supported living provider. That's more common.
and I know from your sort of neck of the woods in terms of Leeds and sort of Yorkshire. Des Taylor obviously is talking about sort of selective licensing coming in Leeds, and then they've got Article 4 in Manchester. And would you say it's getting harder? Are you seeing that a lot of these sort of HMO landlords or portfolio builders are struggling out there at the moment with the increase in red tape?
I think I think it is getting harder. It's making the skill level required higher. So those are operating at perhaps, an easy access level, pick up a property, do it under permitted development, off we kind of go, then, those doors are not closing, that there's far few of them, and they'll become harder to access because more people will be looking for those kinds of deals.
Mm,
But overall, it's an opportunity, isn't it, to look at other stuff and to kind of thin the market out a bit. How many portfolio builders there are, perhaps the ones who are not so good might be the first to go. I'll let you make an opinion on that. But yeah, it is getting harder, but I don't think it's necessarily a bad thing. I think it means that those who remain and want to be active have to be more skilled, have more tools, have more knowledge, and really be experts in their area, which is always a good thing, right?
yeah, Rob, I love it. I'm chucking negativity at you, and you're bringing measured positivity and optimism back at me, which is always good.
I
Um,
built a business in a recession, Chris.
Yeah, exactly. Nothing phases you. Nothing phases you. So the title of this webinar was below market value property. And
Mm,
I'm going to be honest with you, Rob. In my previous life as an estate agent, the moment an investor or a developer would say below market value, I would roll my eyes and sort of recess into my chair away from them as much as possible because I as an estate agent, I would always see as them trying to get a deal out of me and trying to knock my vendor down in terms of price. But
mm.
that's not necessarily if you're going to an estate agent for below market value deals, you need to really understand what the position of the vendor is before you try and push that. If you're just going to knock 20, 30, 40 grand off every property that you come across, you're not. it's thrown as much as at the wall and seeing what sticks, basically, rather than and potentially wasting a lot of time. So it'd be really interesting to hear from you, Rob, in terms of sort of the customers, the clients that you're dealing with, below market value, what it means to you, and what kind of opportunities you've seen other investors and landlords that have been sort of looking at recently.
Yeah, so I kind of agree with you. If you're viewing properties that are on for sale on the open market via an estate agent, then generally speaking, a lot of those sellers are looking for the best price they can get. That's why they're kind of using an estate agent, at least at that point in time. Maybe later things might change depending on how long they're there. But initially, when they go there, they're looking for a decent kind of sale price, and therefore cutting them down a lot, particularly if it's a property that's a bit new to the market, might not be a successful strategy and more of a numbers game, like you indicated. You might get some results, but you've got to go through the numbers to get it. The secret sauce is to find the motivated sellers, the people who want or need to sell property within a shorter period of time because they have some event that requires them to do so. They're more motivated to sell and therefore likely to accept, a lower selling price for that. And there can be lots and lots of different reasons why people might be motivated. I tend to think that in my experience, most of those kind of below market value deals don't come from estate agents. They can come from auction. It's expected that you're going to buy something below market value, quite often at an auction because, that's why it's there. They're all motivated because they're at auction, right? They want to get rid of it quickly and they want a guaranteed sale. So that you've got a captive audience of motivated sellers, really. I really like auctions for that reason, because it cuts down all the time to have to source or go through, do landlord letters, networking, however, whatever strategy you've got. There's just a pool of motivated people there. All right, everybody else has got access to them as well, but it doesn't mean you can't get great deals. And other than that, they tend to be through personal connections and offline marketing, what I would call like landlord letters or other strategies to get in touch with people. That's really where your below market value deals come from. Perhaps somebody's selling and the sale's fallen through, and then you speak to them and you go, oh well, I really need to get rid of this, and a deal's formed. That's kind of what I see from our clients is how those deals make themselves appear.
Great. And in terms of a below market value deal, would you structure it in terms of financing it different to how you would structure any other deal?
Yeah. So actually, I'll answer the other question that you asked before that I didn't answer, which is what is a below market value deal? Um, it can be various things. So I actually put this question in a talk that I did the other day, and I said, well, what's below market value? Now, we all know that if you are buying, let's say, a buy to let, and you look at the sold prices on a bricks and mortar basis of other buy to lets in that area or other residential properties in that area, then what you're looking for is this price per square foot less than the price per square foot that they've sold for within a quarter-mile radius? That's pretty much what it is.
Yeah.
It's a very, very easy way to look and say, what's the value of the property? What have other things sold for? Um, but in the context of what we do, when we basically we help investors fund their deals through mortgages and property finance, we deal with lots of lenders. They have their own definition of what below market value might be, and it's not just the black and white of this property, on that valuation basis is less. It could be other things. And let me give you an example. So actually, it's all about valuations, not about below market value. It's all about valuations. Because if you value the same asset in two different ways, it's worth two different amounts. So let's look at HMO, right? So if you've got a 5, 6 bedroom HMO and it's all en suited, and you're buying it from a property investor, let's say, or a contact, and
Mm.
you're going to buy it on a bricks and mortar basis. So what is that building worth, as a house, as a building? And you're going to pay 250 grand, but it's got 50 grand a year income coming in. And then you bring it to us. Well, we're going to go to a lender where we can value that on a different basis. We're going to value it on a yield basis. And what's going to happen is that lender's going to come back, or that surveyor's going to come back and say, okay, well, using the whatever percentage yield, 12%, average for Manchester, that property's worth 400 grand. Now you're buying it for 250 and it's worth 400 on this valuation method. That is
Yeah.
now below market value. You're buying a below market value property. And the same applies for kind of blocks of flats and things as well. There's different ways that things can be valued. And what it's about is it's not always about using the cheapest lender or picking the lowest fee or, all that stuff. It's about using the finance tools that are available to effectively um, um, make the property below market value and then access specialist tools. Now it classes below market value, can access other things. Maybe that might mean we can access a 10% deposit to buy that property. Maybe it might mean that we can get 100% funding on it. There could be various things that we could do there. So that to me is the answer to the below market value question. And what was the next one, Chris?
How would you structure those deals? So if I'm coming to you and I found what I believe is a below market value deal, let's say, for example, it's a 3 bed mid terrace in Leeds and going
There's
rogue.
loads of them. There's loads of them in Leeds.
Yeah. Look, right, and I'm going to butcher it because I don't know the Leeds market well. But let's say I've found this one for 200 grand, close to a nice affluent part of the city centre. But
Yeah.
we know that they normally go for 250. What am I doing when I'm coming to see you, Rob, with that deal to make sure that I can fund that deal?
Okay, so what we're looking at is when we look at kind of below market value, well, there's two things, isn't there? There's below market value and there's open market value, what we call BMV and OMV, right? Below market value, for us, if you're bringing it to us and we want to fund it, we really want it to be 25% below the open market value. That's kind of the ticket to get in the door. That's the opening line. 25% difference between the two. So if you've got what 200 into 250, then you're 80%. So it's not quite strong enough, right? You want it to be a little bit more juicy than that, really. Doesn't mean it can't work, but you're not going to get the full potential from the finance products that we've got available. So below market value is, what is it you're buying it for? Open market value is what would it sell for compared to other properties of that type. And if you're looking at buy to lets, it's really easy because you just look and say, well, what did other buy to lets sell for on the same street and the few streets next to it? And was that relatively recently? Were they in the same condition? And what's the price per square foot? Um, the current market's really primed for those deals because it's a massive seller's market at the moment. There's so many things out there that people are terrified of or nervous about. You've heard it all before. You've seen it all over social media. Renters' rights reform, EPC issues, making tax digital, war. All these things are going on. But people need to sell, but people don't necessarily need to buy. So you've got all the sellers out there, and a market fundamental number one is supply and demand. So there's a lot of supply, and the demand's holding back at the moment, maybe not forever. So that creates an opportunity to then curate deals basically with people, particularly auctions, in places like that. So if you're buying this property, then let's say that you're buying it. Let's make the numbers a bit easier, right? Let's make it a crazy deal. You're buying it for 100,000 and it's worth 200,
Mm.
right? So you're effectively buying it at 50% market value. And I say that because I can work that out in my head while we're on this webinar. But then when you come to us, then we look at the first thing we want to know really is um, what is your objective? Is your objective to acquire this property and add it to your portfolio and increase the equity in your portfolio? So you just want to buy it for as little money as you can, putting as little of your own money in as you can, I should say, and add it to your portfolio. And then you've got, 100 grand mortgage, let's say, and 100 grand of equity in your portfolio. Or option two is your objective to pull out all the gain and use that to go again. So you want to actually pull out all the money up to 175,000, let's say, or 150,000, and not have as much equity in the portfolio. There's two agendas there. Get them as much cash out as I can, or not bothered about pulling cash out. I've got plenty in the bank. I just want to add it to my portfolio with the least hassle and the lowest money required. So once we know which one of those it is, it then dictates which route we're going to go down. Um, and if we're in the camp one, let's say, so we don't need to pull out all the equity, we don't need all the cash, we just want to add it to the portfolio, and we're building the equity in the portfolio, then actually we've got there is one mortgage lender that we've got who will allow you to go straight to a mortgage and put a 10% deposit in, potentially, right?
Mm.
And that is a unique thing. And the reason it's unique is because all mortgage lenders historically, when you buy a property, consider the value of the property to be the purchase price. So if you're buying it for 100,000, even if that property is worth 500,000, they're going to say it's worth 100 grand to us in our book. And therefore, we want 25% deposit of the 100 grand that you're paying for that property. And then you can buy it with a mortgage with us. But we have a lender who will say, actually, you're buying it for 100, but it's worth 200, and we're comfortable with that. So what we'll do is you just give us a 10% deposit. So now you can access that property for 10%, 10 grand basically, to get a 200 grand property. Add it to your portfolio, and you've got all that equity. You've got 100 grand's worth of equity in there. You're not pulling the cash out, but you've deployed very little of your own money to add it to your portfolio. That's the simplest way to acquire a property like that. If your agenda is to pull all the money out, then we go down a different path. Yeah, we're at
Mm.
this fork in the road. So that's one way. This is the other way. When we go down the other path, we then have to say, well, are you going to do works to it? And let's say, no, you're not going to do works to it. If you were going to do works to it, then it's really easy to remortgage it quickly after you've done the works and pull out the equity, because lenders understand that if you've spent money on it, the value's gone up, right?
Mm.
In their kind of simple way that they work and their risk mitigation, they know you've spent money, it's gone up, we can accept that. The difficulty has been that if you buy it for 100, you don't want to do any work on it, yeah, but you want to pull out the equity. Well, how do you do that? Because most lenders, what they'll do is they'll say, well, got to hold it for 6 months, yeah, until we allow you to pull out the equity, because we're going to treat the purchase price as the market value for the first 6 months, or um, what they will say is that you can mortgage it within the first 6 months, but we'll just treat the purchase price as the value. However, there are lenders appearing again, because these used to be available pre-credit crunch, right? Everything changed in the credit crunch. Mortgage rules changed the whole thing. And then you could mortgage anything. You could do it in a day. You could ring up your bank manager and go, I bought this property yesterday for 50 grand. It's worth 200 today. And they go, okay, that's fine. I'll give you more money and then I'll go buy some more property, right? But
Mm.
we know what happened at the end of that story. Um, but there are lenders now where, let's say, I've done this myself. I bought a property for 78,000. I knew it was worth about 150. So what I did is, as I started the legal process to buy it, I also started a mortgage application with a sympathetic lender who would allow me to mortgage it immediately after purchase without doing any works and look at the market value. So I paid cash for it, but then my mortgage completed very, very quickly after. I'd already had it valued by the mortgage lender before I even owned it. And a week after I completed my cash purchase, I then completed my mortgage, pulled all the money back out, and I could have had more if I wanted to. And that's what they call a same day remortgage or a day one remortgage. Um, so the difference there is about the works, really. If you'd done works on it, then it would be fine. The lender wouldn't care. But you can't do the works in a day or a week anyway. You've got to buy it, do the works, takes a couple of months, then you remortgage. But if you buy an under market value, then you can buy it cash or you can buy it bridge and effectively remortgage on the same day if all the stars were aligned, if we got the timing right on everything. So you could deploy your money for one day, or might even be a paper exercise, depending on how the solicitors do it. That is a unique and new thing, which has not been available for that long. It has been available for about one lender, but now there's two or three lenders where we can do this. We don't have to pay crazy rates.
And Rob, in terms of when I'm thinking a little bit further down the line and the perspective of a developer, when you look at the um, sort of training that a lot of people are given now, is to consider multiple exits with every strategy that they're doing. So, like you said, when you took that property on, you became an accidental landlord and started
Yeah.
renting it out. I think a lot of people would go down the route of immediately trying to flip or do a BRR if they're not looking to build their portfolio. I think one of the main concerns is taking on a BMV is that the valuation at a later stage when they come to sell that or come to exit that property. Is there anything that they can do to ensure that the valuation stacks up when they do look to sell it on? Because you know as well as I do that surveyors have a mind of their own and don't necessarily buy into what the lenders say, and they'll come out to a property. And my experience of surveyors is that if they chuck the keys at you when they come back into the estate agency, there's a good chance that they've downvalued it. Whereas if they come in and say hello
Is that the
and
secret?
hand you the keys back, then there's a good chance that they've not downvalued it.
Yeah, I mean, look, I'm not gonna name and shame any surveyors here, but a lot depends what type of asset it is, right? So standard properties like buy-to-lets and residentials, which is mostly what you see in estate agents, are generally valued by the big surveying firms that we all know and probably hate to some degree. Um, and those valuations can be quite erratic depending on who you get and what they're feeling like on the day. We all know that we've all suffered the pain there. A lot of what we do is more specialist stuff. So we do a lot of, like HMOs, blocks, commercial development, bridging, auctions, obscure properties,
Yeah.
sometimes obscure people, all sorts of different things, right? So when we do that, we don't use those big high street surveyors. We use specialist panels of surveyors. And quite often we've got control over which surveyors we're going to use. And if I use the HMO example, so this is really good. So um, you go and you find a 2, 3 bedroom property, spend all that time doing your sourcing, you find the property, you negotiate the deal, you go through the legals, you sort out the finance, you do all that stuff, you put all that time into that, you do the build, schedules of works, every detail, all the finishes, right? You get your licensing, you go through all of that, you've got your electrics and your utilities, you've got your planning if you need it, you refinance it. And then when it comes to the valuation, they just got to pick the cheapest surveyor, right? And when you look at the HMO strategy, the most important factor in there for the HMO strategy, because HMO strategy for commercial only works on the valuation. The valuation is the most important bit of that strategy. And yet, quite often people have not paid that much attention to it and just thought, well, all surveyors are the same. I just pick that one, they'll come out and they'll do the job. All surveyors are not the same. So we kind of developed a strategy for minimizing risk on HMO valuations. And we developed this 3, 4 years ago on how we were going to do that. We were going to use lenders that gave a commercial valuation truly, that the proper commercial valuation, not I'll say we do it, but actually when we get the valuation, if it's too high and we don't like it, we'll argue it down, or we'll give the surveyor a load of criteria that effectively means he's valuing the property with his hands tied behind his back. We don't want any of that stuff. So we want the right lender. And then we want to use a surveyor who we know understands HMOs in this area, and knows how to value them properly, not overvalue them or undervalue them, but knows how to value them properly. And we want the freedom to pick that surveyor. And if we're going to do a development, we're going to turn this property into a HMO. Guess what? We're going to value it twice.
Hmm.
We're going to, in the beginning, when we get our development finance from a bridging and development lender, he's going to come out and say, yes, it's worth this. And then when that's finished and the work's done, we're going to go onto a mortgage and we're going to get it valued again. Well, guess what? We want the same surveyor because that minimizes the risk, right? We don't want two different people coming out and number one says it's worth 400K. Number two, at the end, after you've done all the work, says it's worth 350. Now you can't get as much money out on that mortgage. You can't pay the bridge. Maybe there's a private investor. You're not getting the money back to go again and do your next deal. HMOs are all about this kind of momentum. So we really minimize the risk by doing all these things between the grey that a lot of mortgage advisors and mortgage brokers weren't doing, sort of 3 years ago. And that's kind of the backbone of what we've done. So valuations are really, really important. They are in many circumstances more important than the fee or the product interest rate. Because if you have a choice of saying, well, I select this lender here, which is the cheapest lender, which is, I don't know, 5%, or I can have this lender here, which is 5.5%, and I'll get 100 grand more in my pocket. 99% of HMO investors are picking the 100 grand more. They don't, it's not the 5% on, not 0.5% on the interest rate, because that's what makes those deals stack up. Now, we understand that and we have understood that for a long time, but a lot of the mortgage brokering and mortgage advisor community haven't, because the training and the cultural kind of way of working has always been pick the cheapest possible interest rate and the lowest fee, and this is the right product for the client. But actually, there's been the lack of understanding about what the agenda of the client is, what the actual goal of the client is. So we started doing all this stuff to kind of minimize valuation risk. That's how we did it with HMOs, and then there's other things for blocks of flats and buy-to-lets. But to answer your question, if it's a standard property, normal residential buy-to-let, whatever, chances are you're going to get a high street kind of surveyor, and there is a bit more risk with that.
Well, it's really nice speaking to you and having that reassurance because I can imagine from the conversations that I've had with a lot of developers that the most nerve-wracking part is the valuation, and to see that you're so heavily involved and have got a strategy for that in terms of selecting the same surveyor and steering away from some of the ones that you know are going to potentially cause problems is good.
Look, the other thing, Chris, is, as a mortgage brokerage, we see hundreds of valuations
Yeah,
from all different surveyors in all different areas of the country for all different types of property and assets. We've got all that kind of data coming in. So we get to see, what the values are on all different things and which surveyors are doing a certain thing and which surveyors are doing something a bit different. And, we've got that intel there. And if that intel then helps our clients who are working with us to um, to manage their risk and do better with their projects, then that's a great thing.
brilliant. Guys, if you've got any questions, do please put them in the chat. We want to make this session as interactive as possible. And Rob is here to answer any questions that you might have. So we're going to go to our first one from Donna. So, what's your advice for someone to get their first flip? I'm based in Essex, use a property investor platform. The agents are very good with me. My offer is based on what the GDV is, less all other costs. A lot of them I look at are probate less market value. Already they need lots of work normally, but still a struggle to get an offer accepted. I have now signed up for an auction as this seems to be the only way. And if any further advice, please.
What's your advice to get there for the first flip? So, um, I think that's the starting point for me is always, is it the right strategy? That's where I kind of start with everything. And the question to ask is why are we doing a flip? Um, and I think it comes back to starting with the end in mind. So what are you looking to achieve? What is your kind of goal for property? What's it going to do for you? Where is it going to take you? 90% of people when they're starting out actually need cash flow.
Mm,
That's the starting point, because the cash flow, at least at level one, where it meets your minimum household expenses and bills, once you do that, then that's effectively the financial freedom. You're now not tied to swapping your time for money in an office or a shop or wherever it is that you might be working, and you're broken away free from that. So flips don't give you cash flow; they give you a capital injection, and also they always take longer than you think. So I do some flips, and they're pretty much, I might be quite rubbish at it, and I try to take my time anyway, but they always take coming up to a year, right? For me, by the time you've bought it and you're 3 months buying it, and then you're 6 months doing some work or 4 months doing some work, and then 3 months exiting, there's a year there that's gone. And what I look at is how many of those can I do? I'm 44 now. Do one a year or two a year, two at the same time or whatever. There's only so many years that can go by. And is it actually getting me towards my goal of where I want to be? And if not, I'm just wasting time. So I think the first thing is to question the strategy. Also, the air I don't know what Essex is like, and there's lots of bubble areas and stuff. There's great places to invest. But the other thing I would be cautious of is it is a buyer's market, not a seller's market. So if your only exit is to sell, then what happens if that exit doesn't work? What's the plan B? Can you rent it out? Can you do something else with it? So I would always think about having a couple of different exits there as well, for sure. But in order to buy a flip, where you're going to find one from, I'm probably not your best person to ask about that. I'm not an expert sourcer. For me, I use auctions. And the reason I use auctions is because I am a lazy sourcer, I guess. My primary job is to be a dad and look after my daughter. Beyond that is to run my business, which is helping other investors fund their deals through traditional finance. And then beyond that, I'm a property investor. So I'm not a full-time property investor. I do this kind of part-time on the side. Um, and I don't have time to go out and do landlord letters and all these kind of strategies that you see people doing. So I go to auctions because auctions have a captive audience of motivated sellers, and I want motivated sellers, and I want the assurity of knowing that if I win the property, it's being sold, and there's no messing around with that. Doesn't mean you can't get great deals. One tip I can give you is look for properties that don't sell at auction. So follow the auction, look what happens, take a note of the ones that don't sell, go back and make an offer because they really want to sell their properties. That's why they're there. And if they haven't sold, they still need to kind of sell. I bought a flat at auction last year. When the property was built, it was sold for I think 120 or 140,000. When it was in auction, it was in there for 60,000. I bought it for 38 after the auction had finished. So I didn't even pay any stamp duty on it. Um, and that's an example of doesn't need any work, by the way. So it's ready. Just well, actually needed a part on the boiler, which was about 100 quid, but it doesn't need any work doing to it. So if I want to go to a mortgage lender, the mortgage lender is going to go, well, I'll give you a mortgage based on the 38,000 until you've had that property for 6 months, and then we'll look at it on the market value. But actually, we've got solutions, as I was mentioning earlier, where I bought this cash for 38,000. I could have lined my mortgage up to complete on the same day as my cash purchase and got it revalued. I think it'll value at about 80,000. So I could pull out 60 if I wanted to on the same day and do that without doing any work to it or anything. The value is in the buying below market value and going straight to a mortgage. So while you've got your legal purchase happening and the timeline starts on there, you've told your solicitor he's doing his searches, it's going through the legal process. You're also coming to somebody like us. We're starting a mortgage application at the same time. You've got these two trains running next to each other. And what we want them to do is both arrive at the same time and complete at the same time on the same day, ideally. And actually, that's a day one mortgage. Money in, money out, immediate, right? Or maybe not even any money in. Maybe it just happened. Maybe it's a paper exercise. That's the magic that we can talk about below market value.
Yeah, I would definitely say that in terms of flips, Donna, the sort of market that's available is quite a finite resource if you position yourself against the buy-to-let investors that are looking to add value and put a tenant in there, as well as other people looking at, serviced accommodation or supported living. The auctions are probably the best place to pick up those deals, but you've got to provide your own due diligence on what you think the market value of those properties are worth before you go into the auction. That's why you see so many people that have previously done flips pivot into stuff like commercial to residential, because those are properties that are effectively flips. They're just a different use class of property that they're having to navigate. And that's where they get the value out, is that they're taking something that was previously not occupiable, or not livable, and then turning it into a residential property. And I guess that's the same sort of train of thought of any person that's trying to flip. There is a uncapped amount of commercial to resi opportunities that are currently available out there at the moment, but the amount of flip properties that there are, unless you're looking at something that is completely derelict and that is very, very run down, there's it's a real struggle to make those margins. I mean, I was literally in Birmingham city centre on Saturday, and I was taking my mother-in-law around, who's from Suffolk, and she couldn't believe that in a quite really nice area like the Jewellery Quarter, which is associated with, Jules Holland and the Jam House and all the engagement rings and all the rest of it,
Yeah, been
just
there.
around that section, how many derelict, literally run down properties there are, and why people haven't been in to renovate those yet. And the big reason is because one, they probably the margins probably aren't in there to flip those, but also second of all, you're dealing with contaminants in those properties that you might not necessarily been aware of, such as uh, asbestos or radon gas or whatever it is. So it kind of sort of narrows down that market quite dramatically. We'll go to the next question from Mark. Are there lenders that will lend without personal guarantee?
My question when people ask this is why? What are you hiding, Mark? What's the problem? Um, yeah.
Mark,
Um,
if you could come back to us on that.
no, you don't have to answer that question. So there are lenders that will lend without a personal guarantee, depending on what the deal is and what they assess your credibility as being at. But realistically, if I was talking to a client and they asked me, I said, "Oh, I want to lend without a personal guarantee," then I would need to find out a little bit more about why that is and see what the issue is really, if there's a different way that we can resolve it or a concern. Um, I have business partners who won't do a PG. Um, so a lot of traditional lenders will want a personal guarantee. Not all. The answer to your question, because I do ramble on a bit, is yes, there are lenders who do that PG.
Okay. And Mark's come back with, I have business partners who won't do a personal guarantee.
Yeah, yeah.
So
Why? You want to check those business partners out and make sure you've done your due diligence on them.
Ade's asked a question. It's a bit more around the sort of sourcing element, but I guess in terms of funding, this is quite relevant. I'm looking at sourcing 20% below market value, 3 bedroom with terrace property to convert into 4 bedrooms. What should I be looking at in terms of the difference between traditional buy-to-let and HMO rental income?
Sorry, what's the question? What should I be looking at? There's a lot of
What should I be looking for in terms of the difference between traditional buy-to-let and HMO rental income?
Wow, it's a really broad question. I don't think I'm the right person to ask it. So if you're looking at buying a property, you're buying it below market value, but you want to know how to stack up the rent as well. So to stack up the rent, you can look on, use things like spare room for like HMOs and places like that to see what properties are renting for in the area. Look what standard they are as well, and then you basically collect data to get a benchmark. So you find 10 rooms and how much are they renting for to the same standard that you're going to have your rooms, and get an average over those 10. That's what your room can be rented for a HMO. For buy to lets, you can go to local estate agents and ask them and say, if I rented this property as a buy to let, what would my rental income be? And they'll tell you, what they'll rent that for as a buy to let. Um, but yeah, if you're going to do a HMO, then you're probably going to pay the utilities and the council tax and all that stuff. So, make sure you factor that into your kind of pricing. I think those smaller HMOs, depending on where they are and what the market's like, obviously, it's a bit of a generalization, but smaller ones like 3 and 4 bedrooms, they can be a bit more risky because if you've got one empty room, the whole deal kind of falls down and you don't make enough money to cover the costs. So just be aware that when you stack it up, have a look at what it's like if you had one room empty, for example. Where would that kind of leave you?
Yeah, Adi, what I'd say is that maybe at this probably starting your property journey, a HMO would probably not be the best idea to get into in terms of the fire regulations. The the management is going to be so extensive, particularly if it's your first one. I would probably recommend leaning more into a traditional buy to let if that's something that you feel comfortable with. Um, that
You
in
won't get a commercial valuation on a four bed anyway, unless it's in an Article 4. So that main kind of gain from HMOs is that you get a big jump in value and you can pull the money back out and recycle it. But that won't occur with a four-bedroom one anyway. You're still going to leave potentially quite a bit of money in the deal. So it's like you've got the downsides of both, really, to some degree there. Go five beds if you're going to do HMO. Mine was.
Yeah, definitely.
And get a management company like Chris suggested there, because you don't have to be a landlord to be a property investor. I don't manage any of my properties.
Yeah, 100%. I strongly recommend for your first at least two or three properties that you get someone to fully manage those properties. It will take a hit out of your cash flow, but just giving you that peace of mind, particularly when you sort of start to learn what some of the things that tenants will phone you up for, or what kind of
Yeah.
requests that.
Depends what you want to do as well, Chris, right? Because, do you want to create another job for yourself? Because I always separate the two, landlord and investor. So the landlord is the guy who takes the phone calls from the tenants at 2 o'clock in the morning and goes to fix the pipe, and all that kind of stuff. Whereas the property investor is the one who has the systems and the processes and other people who do that, gets a
Mm,
lower return, but does much, much less work for it. I would, for me, I'm in that camp. I get that some people are full-time property, they want to do the whole management and everything. That's fine. They actually end up building a business out of it most of the time. Um, or people who are maybe retired or learning in the beginning. It's good to understand everything and kind of get your hands dirty to know how everything works before you pass it over. But for me, I have zero time for that. So I just want to be the owner and the manager, but I don't want to be doing the day to day.
that 100% totally agree with you. So yeah, Adi, what is it that you want to do? Is it that you want to be a bit more hands-on, or do you want to um, do you effectively want to invest in property where you've got those systems and processes around you? But yeah, I hope that hope helps. Rob, in terms of tonight, I've really enjoyed it, and we're so pleased to have got you on. Where can people find you? Where can they reach out to you if they want any further information? If they're looking at a BMV deal at the moment and they're looking at ways that they can fund it, what's the best way to get in touch with you?
So the first question is it 25% below market value or more? You've got to tick that box really for us to do something exciting with it.
Yeah,
If it's not below 25% and you just want to get hold of it and you just want to buy it anyway because it's a great property, we can still help. But if it's 25% below, there's some exciting stuff that we can do where you might have to put very little or no money in, depending on what we're going to do, right? You can find us on the UK Homes network app. Absolutely. You can contact us through there. You can contact us through our website, which is just Google Simple Fast Mortgage or Rob Peters Simple Fast Mortgage will come up. There's a form on there. It takes 20 seconds to fill out. Contact us or get started, and then we'll be in touch with you and we'll set up a call. That's what we do with all our inquiries. We set up a call to go through your situation A to Z. We're on all the social media platforms, all the main ones anyway. So Facebook, Instagram, and LinkedIn are the three that we're on there the most. We're going to start to launch our YouTube channel soon, and push that. But yeah, we're not hard to find, Chris.
great stuff. So please, guys, do reach out to Rob and the team, and they'll be more than happy to help you guys. Rob, is there anything else you want to plug before we wrap up for the evening?
No, not really. It's been a pleasure to be here and chat with you, Chris. And apologies if I've rambled on a bit. I tend to
Oh
tend
no,
to do
you're
that
fantastic, mate.
sometimes in the evening.
Yeah, no. It was really insightful. I think the thing that you can sometimes find with these webinars and particularly when you get into the more technical side is that it does become quite confusing, particularly if you're not sort of financially endowed. Is that the sort of the correct
Yeah,
sort of term?
yeah.
But
And
I
without
really like.
visuals as well, it's just like numbers, isn't it? You start to fall asleep.
Yeah, yeah, and I really like the way you explained it. I've sort of undiagnosed numerically dyslexic, so when I start seeing ones and zeros floating about, it kind of loses me a bit. But you sort of really clearly uh, explained everything, and it really sort of I could visualize how the deal was being set up. So thank you very much. We'll have to get you back on, Rob, and obviously we'll see you in Manchester and Leeds, which we're very much looking forward to.
Yeah,
But guys,
looking forward to it.
yeah, absolutely. Guys, please do reach out to Rob and UK Homes Network. Drop a post in the feed if you've enjoyed tonight, and we will catch you next week where we'll have Jessica Leader on the webinar. So thank you very much, guys. Have a great evening, and we'll catch up with you soon.